All right, welcome everybody. We're very privileged and fortunate to have three experts from Florida talking about the insurance situation in Florida. I'll avoid calling it a crisis because maybe that's an inappropriate label. We'll leave it to them to sort out. Let me just introduce them briefly and then I'll get out of the way. Our plan is to give each of them 15 minutes to talk about whatever's on their mind and then leave some space for questions afterwards. So starting off will be Peter Molk, who joins us from the University of Florida Levin College of Law, where he is the John and Mary Lou Dasburg Professor of Law. Professor Molk has written empirical work on moral hazard in insurance. He teaches insurance law and corporate law, and he's written about health and climate change insurance as well as a wide variety of corporate law topics. 150 miles to the northwest, in Gainesville, we can find Patricia Bourne. She is the mid-yet eminent scholar in risk management and insurance and director of the PhD program in the business school at Florida State. She's widely known for her careful and sophisticated empirical work on an incredibly wide range of important insurance questions, from regulation and policies such as whether insurance exit markets after natural disasters and what drives underwriting cycles, among many other topics. And finally, certainly last but not least, Lisa Miller joins this panel also from Tallahassee. She has a long and distinguished career both inside and outside of government, including stints as Deputy Commissioner for the Florida Office of Insurance Regulation and Chief of Staff for the Department of Financial Services, overseeing both the banking and insurance sectors in Florida. She helped to develop and implement the state's $250 million homeowner mitigation program to help homeowners strengthen their houses against hurricanes. And she's currently the principal of Lisa Miller Associates, a lobbying and consulting firm based in Tallahassee. So our plan is just simply to turn the panel over to these three speakers and let them tell you what they know, giving some time for questions at the end. Please feel free to raise your hand with the WebEx hand raise function, or you can chat your question to me or to Travis. And please come back in 2 weeks when we'll be switching gears entirely and talking with Kenneth Abraham and Kathy Sharkey about the glaring gap in tort theory, which is that there's not enough insurance in tort theory. Okay, Peter, the floor is yours, or the virtual floor is, and thank you both. Thank you all three for coming and joining us.
Thanks, Peter and Travis, for organizing this, and all of you for being here. I'm going to try and pull up. I'm the one with slides, so I think that's why I'm going first. Let's see. We had this once. Are they back?
Yep.
Okay. I'm not sure if crisis is the right word, although I certainly feel like it's a crisis every time my policy comes up for renewal and I see what the new premium is going to be. So that hasn't been for a little while, but this talk has given me the opportunity to make sure I got enough of my savings account to cover what apparently is going to be happening this upcoming renewal season. All right, so I think that the goal that I have here is to provide some context for what's been going on in Florida, what are the perceived problems that have led to what has been characterized as a crisis, what has been done about the problems that we've been seeing, and what steps we might think about going forward. So I told Peter the reason I had slides is because I have an awesome slide. I may have oversold it a little. But here's our former insurance commissioner. I don't think he was putting quotation marks around characterizing this as a crisis, but instead he's pointing out the apparently objectively true facts that over the last 3 years we've had average premium increases down here of just over 100%. We've also had homeowners who consistently get non-renewed, so they may be willing to pay the premium increases, but their insurance company is just telling them, no, your house is too old, or for whatever other reason, we don't want to insure you, try and find someone else. We have other insurance companies that say, sure, we will pay you, or we will allow you to be our policyholder. You have to pay our high premiums, and you have to replace your roof proactively if you want to remain one of our policyholders. And all three of these are they don't paint a rosy picture. You have people paying more money for the insurance that they had at a cheaper price just a few years ago, assuming they can find coverage and assuming their roof is in good enough shape that they don't have to pay the like $30,000 or so every 15 years that we seem to have to do to put new roofs up on our houses. So I want to talk a little bit about how we got to this point. So I imagine I've seen several Connecticut folks on this call. So I've got 3 lines. The Florida average insurance premium line if you want to insure a $200,000 to $300,000 home with a HO3 policy. And these are nominal dollars. So you can see Florida, the nationwide average, and Connecticut. And these are all numbers coming out of the NAIC. And you can see up until 3 years ago, Florida looked perfectly fine to me. It's obviously higher than Connecticut or the nationwide average, but we have certain structural and geographic things going on down here that make average risk levels somewhat higher. But you don't see big changes in our premiums over time. If you want to look at percentage changes and what was happening leading up to the last 3 years, Florida is bouncing around a bit, but if you look at the scale of the chart, it's going from a low of dropping by 6% to an increase of, at the high end, only 8%. So from 2013 to 2021, I could have kept going back farther than this, but we had to stop at some point. You see Florida insurance premiums bouncing around, sometimes going down, sometimes going up, but by, I think, fairly moderate numbers. Single digit percentage changes don't really strike most people as out of the ordinary. You do, however, after this period of time, so after 2019, heading into 2020 and 2021, if you look at what Florida domestic property insurance companies see happening, they start having significant, not only net losses, but also underwriting losses. So this is showing that, there was like a nice period leading up to 2019, 2020 or so. Insurance companies, things look pretty stable. They're able to accumulate some operating profits, and then stuff seems to change in 2020, 2021, 2022. That's when you see insurance companies losing a lot of money on the underwriting level and on their entire book of business. In 2023, things start to look okay, but you got to understand by that point, premiums have gone up 100%, and eventually, like, you raise premiums enough, you're going to turn any sort of underwriting loss into an underwriting gain. But I don't think folks are happy here with a potentially new equilibrium of policies significantly higher than they used to be. So what explains how we got to this point? So what explains what was going on in 2020, 2021, 2022? Well, I think a lot of folks often, when they think of Florida, they think of potential for hurricanes, natural disasters. So here's a ranking of the top 10 natural disasters, just in terms of dollar amounts of when they occurred, and then adjusted up to 2021. And you can see 3 of these happened in Florida. One of them happened in 2022, but it's not like we have a series of high dollar value natural disasters occurring in 2020, 2021, and 2022. So it doesn't, 2022 stuff, that's not a great experience, but it's not like we have systematic natural disasters over this period of time that might explain why we go from good underwriting results to bad underwriting results. So that's potentially worrisome, because it's not just like a series of unlucky, potentially one-off events due to natural disaster type situations. So the explanation that folks seem to turn to is that if you look in the last 3 years, Florida, while accounting for a relatively small number of claims against homeowners insurance companies compared to the national average, so 9% of claims, we got a lot of people here. We got like 10% of the population in Florida, so you'd expect there to be roughly 10% of homeowner claims happening down here. But those 10% of claims account for 79% of the suits that are brought against homeowners insurance companies. And this is the popular talking point down here of what might explain the massive increase in homeowners insurance premiums. Now, one thing I haven't seen, I haven't been able to find, but it'd be nice to know, is how has this sort of figure changed over time? Has this been something that's consistently been Florida out of proportion to having relatively large numbers of homeowners insurance lawsuits? I don't know what the answer to that is, but it seems like, as I'll get to in a minute, the structural groundwork has been in place for many years to contribute to what we now see as a problem, which is incentives basically to commit insurance fraud, so that you sue your homeowner's insurance company, you externalize costs onto them, not just in defending suits, but also in paying out questionable claims. And that has at least been pointed to as one of the main drivers behind the substantial increases in premiums over the last few years. So if that's the problem, It's not due to at least systematic natural disasters, not due to like lack of competition. Nothing has changed in the state of Florida. It's not like we have a ton more coastal development than we ever used to. It's not like the risk characteristics down here have changed meaningfully, unless what you mean by risk characteristics is the risk that now you're going to get sued if you're a homeowner's insurance company. Now you're going to get sued by your policyholder in ways that are seen as tilted in policyholders' favor. So the problems that seem to contribute to this that people pointed to is that Florida's got two things going on up until the reform, which I'll get to in a minute. One-way fee shifting statutes, which, as we know, means that if I sue my insurance company and I lose, well, I pay my costs, but I don't pay the insurance company's costs. On the other hand, if I sue my insurance company and I win, the insurance company pays both their own costs as well as mine. So anytime you see a one-way fee shifting statute, it's obviously going to encourage litigation compared to parties just bearing their own costs. And you often see this for insurance because there's all sorts of deterrents to suing your insurance company, and one-way fee shifting statutes are a way to try to correct for that. But the argument is that at least in recent years, down here in Florida, you combine one-way fee shifting statutes with these assignment of benefits that have been going on, where you have roofing companies that have excess capacity. I guess I'll put it charitably. They go around neighborhoods, they sign up homeowners in areas where there have been recent storms and say, look, assign us your benefits against your insurance company for the damage that supposedly happened to your roof. And we, the roofing company, will take care of the paperwork, we'll replace your roof, and we'll collect from the insurance company. And when the insurance company questions that claim, the roofer goes ahead and sues them, and they say, look, if we beat you and we win, you're going to pay our costs. If we lose, well, you know, at least we tried, and hopefully we'll at least be able to extract a favorable settlement from you. So that's led to this spurious litigation. So I guess I'll characterize it here. That's led to why Florida has 79% of all suits against homeowners insurance companies, despite accounting for just 9% of claims. So if that's seen as the main cause, obviously approach number one, and I'll transition, I guess, to the last part. How do we deal with this problem? Option number one would seem to be that you reduce spurious litigation. Florida's done this. There are now no more assignment of benefits, no more one-way fee shifting. That certainly should have the effect of reducing spurious litigation. It'll take a few years for you to be able to see that because it takes effect prospectively, and existing policyholders generally have up to 3 years to sue their insurance company. So you would expect it to take a little bit of time to have an effect. Obviously, there are costs of this as well. Now we're going to potentially disincentivize people to sue their insurance company, and that's problematic if you think insurance companies don't always play by the book. But approach number one makes a lot of sense if we want to target what the main problem seems to be down here, which is a lot of litigation going on. Option number two, folks talk about trying to make insurance cheaper. You can do this by, for instance, saying, look, maybe construction costs are higher down here. We need to bring down construction costs. Here's a chart that I don't think we need to spend a lot of time on, but we're welcome to come back to, but basically shows that if you pull up indexes of material and building costs, they're not significantly higher. They haven't grown faster down here in Florida compared to other states, other cities, and other parts of the country. So construction costs, trying to get those under control, that doesn't seem to be a way to really address the rapid recent increase in insurance premiums. Some other folks say, well, maybe our coverage requirements are too high. So a suggestion from this last year that I just heard about is that we should allow policyholders to buy insurance that covers their interest that their mortgage company has only, and go uninsured for your own equity in your house. That's not a terrible idea if you know you're less likely to commit insurance fraud than the average person. It is a terrible idea if you think insurance is out there to protect policyholders from catastrophic losses that they may not otherwise be able to bear. What else could we do? We could, where's my little mouse? We could try to subsidize premiums. So the reform that Florida did in the last year or so contributes $1 billion to reinsurance funds. That's a way to try and bring down indirectly premiums by making it cheaper for insurance companies to do business down here. You have to be careful when you subsidize premiums. So here's a map of the state of Florida basically showing where people live. If you're going to subsidize premiums, Insurance is something that gets talked about, particularly in the academic literature. It serves this great function of providing signals to policyholders of when you're engaging in risky conduct and when you're not. Florida's got all sorts of people engaging in risky conduct by building on the coast. And then they got people like me who live in Gainesville, where there's not really much going on here. Like, I guess either literally or when it comes to potential for hurricane risk. So trying to keep those incentives to locate your home in safe areas is important. And I think that reinsurance subsidies do a pretty good job of keeping those relative cost differentials in place. Kind of stuff you probably wouldn't want to see happening is just bringing down the highest cost policies, because that's going to encourage people to do more of that coastal development in ways that's probably not great from a social perspective. We could try and encourage new insurance companies to write business. You get a lot of people in the insurance commissioner's office saying, look, we've attracted like 7 more insurance companies here in the past year. To me, that seems kind of like a drop in the bucket. There's not really arguments that it's a not competitive market down here. The arguments are more that the costs have gone up significantly. So I always like more insurance companies and more competition. I'm not sure that that's a great way to tackle at least the immediate problem of premiums being high. Expand Citizens. So Citizens is the Florida-based property insurance company. It's kind of like the National Flood Insurance Program, but run by the state of Florida and not for flood losses. I heard folks talking about this just last week or so. We should essentially require everyone to get insurance through the state, make it like a government-backed option. Pros and cons of that, but when I've seen this sort of thing employed in other areas, there's a lot of risks when you politicize a property insurance type system, that the valuable parts, like the pricing signals that are sent, can get taken away. So expanding Citizens is probably not the best solution either. To me, it looks like approach number 1. I kind of like what's being done here. There's more that could be done, which I'm happy to get into if there's time left over after the other 2 folks as well. To some degree, we need to just wait some time and see if I think some of the changes that have already been put in place, how they play out, what more we can do, and how do we correct some of the problems that these changes are likely to cause. So that's where I'll wrap up, and I'm happy to say more later.
Great, thanks, Peter. So let's save the questions for the very end. So just to make sure everybody gets a chance. Patty, you want to chime in?
Sure. Okay.
I'm going to try and make my slide disappear.
So thanks, Peter. You gave a nice overview. I'm probably going to touch on a few of the same issues, but hopefully with a different focus. For my part, I really want to focus a little bit more on the market dynamics, the insurance players that are in the market and what they're struggling with. And I want to go back and take you back to 30 years ago with Andrew. About 30 years ago, the market looked a lot different than it does today. The market in Florida has changed just drastically with both the structure and the way the insurance companies operate. So in the 1990s, we had a few large legacy insurance companies that controlled most of the homeowners marketplace. And we've moved to a market where there's much less diversified and less capitalized firms dividing up that market. So when I say less diversified, what I mean is we have a lot more companies now operating that are only operating in Florida. They're also, many of them only writing homeowners insurance. So they, well, yeah, geographic diversification, of course, is really important to insurers, especially those exposed to property risks and natural disasters. So a geographically diversified insurer compared to one that might only be operating in one area, even one state, a geographically diversified insurer can pool losses across more areas because it's less likely to experience big disasters in every place that it writes. When I say that the insurers are less capitalized, I mean, they really are, they're smaller. They don't have as much in assets, and they don't have access to capital from, say, a parent company or from subsidiaries that are operating in other states. So let's look just briefly at what's happened to participation. I went back and looked at beginning of some data that I had handy. 1996, the top 3 insurers, that was State Farm, Allstate, and Nationwide, they had 46% of the Florida homeowners market. And I refer to these as the legacy insurers. They were really big. They had lots of capital and they were very well diversified because they wrote in most, if not every, United States. By 2000, just 4 years later, those same three insurers had just 36% of the market. By 2010, 26% of the market. So they're shedding, and you might say, oh, that's great. That means there must be some competition, some other insurers coming into the market. By 2022, the top three insurers are no longer those three insurers, with the exception of State Farm Florida, which was a reorg of State Farm. Those top three held just 21% of the market. And if you left Citizens out of this calculation, it was 16 insurers that now had half the market, right? Many more insurers than that, but 16 of them instead of three, leading to each of them having about 3% of the market. So there's smaller footprint in the state, smaller insurers, less capital. And one of the complications for these insurers participating in the market, of course, is their financing for losses, and especially for catastrophe losses. So insurers operating in Florida now versus back with those legacy insurers in 1996 that had capital all over the place, they're much more reliant on reinsurance now to stay solvent in the short and long term. So reinsurance has become a huge issue in Florida. And I want to spend a few minutes talking to you about the process of getting reinsurance. So I think we talk a lot, if you're aware of what's happening in Florida, we talk about how reinsurance is expensive, and we talk about how it's a hard market. And it may be difficult to get reinsurance, but we tend to simplify what that means as if it's the same as each of us as a homeowner picking up the phone, calling an agent, and getting insurance. For an insurance company operating in Florida to get reinsurance is a much more complicated process that I think is something we need to visit in as our place to look for potential solutions. So renewals for reinsurance in Florida begin every year on June 1st. That's a deadline for having written reinsurance policies. And June 1st is the chosen date because it aligns with the beginning of the Atlantic hurricane season. So during this renewal period, the primary insurers, and primary insurers I use to refer now to the ones that are selling directly to all the homeowners that in Florida, Floridians, they have a lot of things to consider really right now and until June 1st. The first is, how much reinsurance do they want to buy? That's going to depend on their risk appetite, what their business looks like in the state, how much risk they want to try to transfer, what their coverage looks like. In determining that, they need to prepare data. So the data they prepare is information about all their exposures, where they are, what they look like, and exposures change. They change constantly. So as Peter mentioned, there's homeowners that are putting new roofs on. There are homeowners that are doing additions to their homes. A lot of things are changing. The insurance agents have written new coverage in different places. So the portfolio of exposures is changing constantly. The insurance company needs to identify where all those changes are and create not just actuarial estimates of what the exposures look like, but also put that information into catastrophe models to see what the catastrophe models are suggesting as their expected losses. And some of these insurers might go into one model, some of them might make use of 2 or 3 models and look at some type of best scenarios out of those models. But one thing about this data preparation really is what do they know about their exposures? How much do they know? I serve on the Florida Hurricane Loss Projection Methodology Commission, where we listen to the modelers talk about how sensitive the models are to various assumptions. And for something like the roof, there's actually quite a bit of sensitivity. If you don't know the age of the roof, you probably in Florida do not want to default to the age of the house, because many roofs have been replaced, and they've been replaced. If they've been replaced following a disaster, the insurer will probably know about it because they may have paid for it, but they may not have because people change insurers. So insurance companies have to figure out how old is that roof with that house, And it's costly to determine that. It's costly to verify. And if it's wrong, they can get different results in their models. So that was just one example with respect to the roof, but all the data the insurers have to put into the model, needs to be verified. So that's a lot of effort to get an accurate picture of what the exposures look like. Then the insurance companies have to take that information and bring it to the reinsurers. Now, this is not calling up one reinsurer and saying, hey, this is what my exposure looks like. Will you sell me reinsurance? No, they often have to go to Bermuda or they go to London. They walk up and down the streets with what they call a submission, information about the risk that they're trying to reinsure. And many times this is not the whole risk that the company deals with, it's pieces of the risk. So the primary insurer takes the first layer, the initial coverage, which is typically for a year where there aren't any type of catastrophe losses. And then once losses in the company exceed some amount, then we talk about a layer of coverage that kicks in with a reinsurer or sometimes a group of reinsurers. And that layer might go from a few million up to another 50 million. And then we need more than that. Insurer might know I'm going to need to go at least up to 200 million or a billion. And so they have to go to other reinsurers and they build layers. And I say layers going up, they build quota share arrangements across layers where insurance companies, reinsurance companies agree to take certain shares of a layer. And this is all negotiation, right? So the primary insurer uses a broker to go basically door to door, or if they're at Lloyd's, they're going table to table at Lloyd's of London to try to get reinsurers to sign on to different pieces of that risk. So in the end, the hopefully by June 1st, the insurance company has put together an entire reinsurance program. Now, of course, the reinsurers have a great appetite for the very high layers. They're going to say, sure, we'll insure you if your losses exceed 10 billion. Very unlikely. They're often willing to sell up there. It's harder to get the reinsurer to come down and arrange for coverage at those lower layers. So there's a lot of negotiation and it can be quite costly for the primary insurer. So this process is what's going on now. And I just wanted to go through that with you to reiterate how complex it is. This isn't just a simple phone call. And insurance companies have to deal with sometimes dozens of companies. A company I spoke with recently said they mentioned working with 70 reinsurers in developing their reinsurance towers. So that it's a complex process, something that is adding to the expense of insurance, because the insurance companies have to go through this process. They have people who are focused on doing this in the company that spend, the full-time job finding reinsurance. So when I suggest that this may be a place to look, it's not necessarily efficient. We may have better options for how we can reinsure or insure an insurance company, whether it's something to do with the state the cat fund or a national reinsurance arrangement. But there's surely some room for efficiency in how the insurance company has to build that extra coverage for risk that it can't bear on its own, right? And so I think we could focus on ways to consider where that risk gets transferred, and maybe in ways that are just more efficient. Just a couple other points I wanted to make, and these may piggyback a little bit on what Peter just said, but one has to do with rating, that primary insurance companies need to be able to charge rates that are fair. So when we talk about affordability, we can't be trying to make premiums affordable for people at the expense of them not being related to the risk. And that means that the premiums should reflect the risk, and premium differentials across the state should reflect risk differentials across the state. Also, in that we know that departing from a rate that reflects the risk is going to create these adverse incentives. For instance, developing real estate in places where we shouldn't. in addressing the affordability problem, I think there are more ways to go through premium assistance programs as opposed to and subsidies to the insurance companies, not to individuals to buy insurance, so that cost consciousness is still there. And then just wanted to make one more point, and then I'll wrap up. And that I had also looked at the litigation pattern in Florida. I was looking at the submissions for intent to file in the property side and against Florida insurers. And this is data that's available at the DFS website. The activity is pretty fascinating, but really disturbing. So just a couple figures. Last year, 421 insurers received at least one notice of an intent to file litigation. So at least one, some of them only one. 21 insurers in the state received more than 1,000 notices of intent to file litigation. About 2/3 of those were alleging denial of coverage, and about 1/3 contesting the damage estimate for a particular claim. So I don't have data to see how these were whether they were dismissed or settled, but I want to make the point that every one of these notices is a cost to the insurance company. So as Peter suggested, this is a place, we could focus trying to get these costs down. And by the way, Citizens last year received over 14,000 of these notices. So just think about how many days there are in the year and how many are being generated per day in that system. So yeah, I just close by saying, as an academic, I'm preparing the next generation for the insurance workforce, that there's some really big challenges out there that make this a very fascinating but kind of scary market for my students, for those of us who do research. And I look forward to Lisa's comments.
Awesome. Thank you so much. And Lisa, the virtual floor is all yours.
Sure. Just making sure you can hear me. Can you hear me?
We're good.
Okay.
Yeah, we're good.
Good. Well, glad to be on this very distinguished panel. Patty and I actually live in the same city in Tallahassee, and I come from a practitioner standpoint, and she comes from the academic standpoint. And it's really nice to sit down with an academic who has practical knowledge. She travels with students and takes them all over the world to meet reinsurers and work within the market and understand the market. It's one thing to sit in a classroom. It's another to actually have students have hands-on application and understanding how the markets work. So it's just a real pleasure to work with her. And of course, I'm an FSU alum, so that even makes it even more special. My contributions today, and I was noticing I've actually answered some of the questions that are in the chat. I don't know the backgrounds of all of our audience, but there's a reason why you, on a Thursday afternoon, are sitting through an insurance breakout session. You either are in the market, you're retired from the market, you love insurance. I often say that once you get the insurance bug, you never leave, because it's a fascinating topic. You think about all the different lines of insurance: homeowners, auto, commercial, life, health, specialty, you name it. And it's a ever-changing, every single day marketplace. We rely in the insurance market on our worldwide investors. I often say that the financial services industry is the most powerful industry in the world. Banks and insurance, they have all the money, they have all the gold. But what they do also have is that they have to keep promises, either in banks keeping their doors open so that our economy will stay strong, and insurance companies that have to keep their promises when a claim is filed. It's really pretty simple. As some people would say, it's not rocket science. So in my experience as a former deputy insurance commissioner, going through all the storms in 2004 and 2005, and actually started in 1990, went through Hurricane Andrew in 1992, I have experienced every single storm that's ever hit Florida. One of the things that I do as a consultant, now that I'm out of regulation, and I loved working with Kevin McCarty. Commissioner Kevin McCarty is one of our greatest commissioners I think we've ever had. And just a lot of fun, if I may say so. He was just a great boss. Is that when you're in Florida and the storms hit, you have to go. If you're someone like me, I have the privilege of the 7.5 million property insurance policies that are in Florida. I work with companies that write about 2.5, 3 million of those. And so those companies, and if you think about our marketplace in Florida, we have about 40 to 45 companies that are, quote, Florida-based companies that write, say, 5 million of those 7.5 million policies. And the 1.5 million of those are in our Citizens, our government's insurance company, and the rest are written by some of the national companies and others just scattered throughout, the state. But the core of our state and a path that we've chosen in our state is that we're going to work with companies to spread the risk, novel concept, to have 40 some odd companies that have anywhere from a couple 100,000 to 800, 900,000 policies. And it's, I hear constant criticism sometimes that they're thinly capitalized. You heard Patty say they don't have a lot of resources to draw from. I know what they pay for their reinsurance. Patty, you do too. And so 40 cents of every dollar they collect, they pay in reinsurance. And if you think about reinsurance, it's in 4 major markets: Bermuda, London, Switzerland, and Germany. And those are where the investors are. Those are where the companies are that choose to support our state. We have, in our state, we have 3 major, I call them crown jewels. We have the Florida Hurricane Catastrophe Fund that has access to about anywhere between 14 and 17 billion dollars with a B. We're the only state in the country that has something like this. It was created after Hurricane Andrew. And I'm actually, one of my clients is a former Florida senator, and he wrote the legislation about the CAT fund in Chapter 215. And he's still in the market, 52 years in the market, working with an insurance company, leading an insurance company. We have the Florida Insurance Guarantee Association. Most states have those. So when a company does go bankrupt, it goes into what we call FIGA, or these guarantees. It's like the FDIC for banks. And incredible staff there at FIGA. And they are managing the claims of failed companies. We all, as Floridians, pay for that in one way or another through what we call assessments, 1% of our premium, 1.5%, whatever the number is, to shore up the finances and get these claims paid. And then we have Citizens Property Insurance, about 1,000 employees. They're writing policies at about 5,000 a week, but they are shedding almost as many as they're writing. When I say shedding, we have, you can go to Citizens if you're in a certain type of, if you're an insurance professional or have a license as an agent, you can get Citizens book of business and look through it and sift through it and decide if there are 20 or 50,000 policies you want, and go through that whole, it's called a takeout program. It sounds like a pizza shop, but that's what we've come to call it. Depopulation is another word for it. So, we have all these moving parts. We have the legislature, 160 legislators, 40 senators, 120 House members. Maybe 5 of them understand insurance total. I do a lot of work in the Capitol. I spend a lot of days there walking the halls, looking at who's on the insurance committees or the commerce committees. I was laughing with a senator yesterday and stopped by to see him. And oftentimes I get calls from legislators because consumers, their number one constituent complaint is how high rates are. And they need talking points to explain why. Does it make it any easier to be the legislative staff person on the other end of that phone to take that call from a retired teacher who says, I'm going to lose my home and I can't afford this property insurance? And it is the number one issue besides affordable housing. The two go hand in hand in our state. So then you ask yourself, well, what are they doing? I mean, there have been reports as recently as last week from reporters who have said, what is this legislature doing for consumers this year? The legislature has made a conscious decision. I'm not necessarily agreeing with it, but they don't need to do any more this year. They've done enough. I think insurance is a perennial issue and should be addressed every legislative session. One of the issues I wish they would tackle is the threat of a bad faith lawsuit. The intelligence that I have from the marketplace is that the lawyers that are no longer able to crank up their litigation factories, there was one particular lawyer that was disbarred by the Supreme Court, who had 10,000, 15,000 lawsuits, just a factory of lawsuits. Those days are pretty well gone. We still have a significant, maybe couple 100,000 suits trying to work through its way through the system because on March 23rd of 2023, when the governor signed the tort reform bill, the race to the courthouse was unbelievable, with firms filing 10 and 15,000 lawsuits to beat the new implementation date of the law. So we've got a whole, cycle of suits out there that we've got to work through. I kind of laugh sometimes. I see that there's several on here that may be very schooled about litigation and what it does. And, I heard stories like, oh my gosh, the legislature took away the right for a consumer to sue. I don't know if you know how many lawyers there are in Florida, but lawsuits are thriving. Look no further than the Department of Financial Services database. In the Department of Financial Services, which is the overseer of insurance industry litigation, you can see lawsuits filed every single day. So there's no shortage of them. And consumers are not saying, I can't sue. They're still looking to do it. They're just more cautious than making sure they have a case and a lawyer's more cautious that they believe they can win, which is good. Unfortunately, the biggest piece that we're all concerned about is that the shift has gone from the litigation factories to perhaps bad faith lawsuits, which is a higher bar. There are some tweaks in the statute that need to be done. Of course, I'm friends with trial lawyers, plaintiff lawyers who don't believe that, but we would like to see more of that. Let me tell you why. This isn't about taking away a consumer's rights, and I spar with my friendly, colleagues in the trial bar. This is about what's fair. I had a conversation yesterday with a reporter who said, how can I sue my insurance company? I have to pay my fees. I said, let me ask you something. If you go to a hairdresser and she dyes your hair green, don't you have to pay the lawyer that you're going to, when you sue her? If you go buy a car and the car doesn't work and it's a lemon, aren't you going to have to pay that lawyer for suing that car dealership? What is the difference? And we went back and forth and back and forth. And, certainly I'm a paid lobbyist. I'm a consultant, an advocate. I help consumers. They find me on the web, www.lisamillerassociates.com. So wealth of information there, lisamillerassociates.com, a library of all kinds of topics, the history of AOB. We do a newsletter every week during session and every other week. Been doing that almost a dozen years, and it's a free service, and people read it all around the world. And we talk about the economics of insurance and insurance in general, and just a lot of things that people find interesting. So I'm out there and I'm talking to consumers. I, actually helped a few seniors, that were locked into some of these roofing contracts, and kind of guided them as to which state agency they needed to go to get help, official help. I was kind of a coach and just cheered them on. But these were very seasoned seniors who knew that they had gotten locked in with an assignment of benefits and wanted to figure out the best way to get away from it. So, this market is not for the faint of heart. Well, I've got a group of colleagues that want to raise $50 million and start a new insurance company, and I'm cheering them on. But at 64 years old, I'm still running up and down the hallways of the legislature. I'm headed down to Orlando tonight and tomorrow for a fraud summit with some of my claims colleagues. I spend time talking to insurance agents from Pensacola to Miami at least every 10 days. I listen to the consumer advocates and what they think are important, and I'm very tuned in to the entire consumer, the Federal Association for Insurance Reform particularly. I listen to what regulators are saying, either formally in committee meetings or in other more formal settings, as well as listen to what they're saying privately and what they think. And here's the good news, and I'll close with this. I just talked to someone sitting at the airport in Bermuda, and he's coming back from placing, or the beginning of the placement of his reinsurance. And when you go to Bermuda, I think, Patty, correct me, there's about 28 reinsurance companies down there. It's a very small circle, and you just walk the circle and take all your submission, all your paperwork, and you say the same thing to all 28 of them or 20 of them or whatever you choose. And his words to me before I got on this call about an hour ago is that I believe that my reinsurance costs are going to level off, and they're not going to be nearly what they were 2 years ago. So for me to be able to say to consumers, I cannot promise you a rate decrease, but what I can tell you is that you're not going to see a 50% increase. And that's what we saw 2022 and 2023 and higher. So with that, I'll turn it back over to Peter, and we've got 15 minutes for questions.
Wonderful. Thank you so much. So I have Bob Yass starting off the queue, and I just saw someone else raise their hand, and I will find out who that is in just a moment. But Bob, you're up first.
Thanks, Peter. I'm feeling very nostalgic listening to Lisa's current stories. It seems like history repeats itself, or at least rhymes, with all these issues. But I'm interested, and I don't know whether this is an academic question or a practitioner question. I'll let you all decide. And I've actually noticed in some of the chat comments, if we don't look at this necessarily as a stovepipe insurance issue, but start to think of it holistically, particularly as the real estate development sector, the property development sector weighs in on this. And we start to look at the all-in costs in Florida, which I think are accelerating. I don't know whether anyone has sort of charted all the costs of home ownership or property ownership in Florida, but is that driving some of the political debate? That is, that the real estate sector, the property development sector, which is a real, as I understand it, traditionally an engine for the Florida economy, both tax-wise and just economically, that they're pushing for solutions that may, and this is really the nub of the question, suppress costs on the insurance side, so that the all-in costs stay reasonable for Floridians.
Did you want to address that to somebody in particular?
Well, I'm
Just
thinking Lisa
anybody who-
first, but I don't know whether
Okay.
we can break
All right.
it out and think of it
Lisa, you're up
academically.
first.
I promised Lisa a question anyway.
Thank you. Thank you, Bob. It's great to see you. It's been a while, and you did some great work when you were with Hartford, and I'll never forget our working relationship, and just always there on the other end of the phone. It was awesome. I think about what the real estate market's doing. We have in our state the Florida Realtors. That's what they're called. It used to be called the Florida Association of Realtors. Now it's just called the Florida Realtors. 400,000 or 500,000 members, pretty strong lobby, advocacy group. And unfortunately, they're not standing on the streets of the Capitol complaining about high insurance rates. I can't figure out why. They're not in there with shirt sleeves rolled up. They used to, but the past couple, 3 years, things have changed. I don't know why. I guess they're too busy selling real estate as fast as they can. But it is the inextricable tie between real estate and insurance is undeniable. And as these rates have escalated, it has not slowed down real estate sales, Bob. I hate to say this, but Florida may become one of those states where only rich people can live. And our Senate president's trying to stop that with her Live Local programs, a bill she passed last year, another bill that she's passing this year to make it better, to try to build those workforce housing units. But even with these high insurance costs, I would say this to the realtors, and I'll close with this because we'll get more questions. Tell me how many real estate closings did not go through because insurance was too high. I've not gotten one single closing that did not go through because insurance was too expensive. You make the conclusion, Bob. You're a smart man. Back to you, Peter.
Great. Okay, thank you. Ken Klein is next in the queue, and I'll take raised hands after that.
Thank you. I am always mindful that any reforms that make lawsuits harder to file and harder to win impact all lawsuits that have evidence to support them and lawsuits that don't. And so my question is spurred by the slide that equated the litigation statistics in Florida as evidence of spurious litigation. And my question is, what data is there to inform us what proportion of Florida's litigation experience is spurious versus merited? In other words, do those numbers stand more for insurer bad behavior versus lawyer bad behavior?
Peter, you want to take that?
Sure, I'll jump in on that first. I think that's one of the issues that tends to get overlooked. That's why, for me, I'd love to see not just that number, but that number over time to see if this is actually something that has been changing. If we could figure out the number that was due to spurious stuff, that would be terrific. I think your question also brings up one of the other issues, which is that if we actually are concerned about spurious litigation, there's more than one way to try to tackle that. One way, the way that has been chosen here, is to try to reduce some of that financial returns, which, as you're pointing out, also has some negative ramifications that it also can cut down on some of the meritorious litigation that we want to see. It's not clear to me why we don't try to target fraud, if that's what's going on, fraud more broadly. Like if it's, here's where like it might be nice to be a sociologist, but if there's been some sort of change down here where in the last 3 years it's just become accepted that you know, I hear people in my neighborhood saying the insurance company makes me replace my roof every 15 years. This company is telling me I can do it for free. The insurance company has kind of been mean to me in the past. Shouldn't I go ahead and do this? If that's like a cultural thing down here, there are ways you could try and target that directly as well and not have the negative side effects of potentially deterring desirable litigation. So I think like the stuff I'd like to see, I'd like to see some disclosure or more numbers type stuff. So figuring out who are the major factories here and then look into their operations to see, are these actually spurious litigation like what you see in securities suits sometimes? Is this more merit type litigation? But that requires looking at the individual cases, which I haven't been able to do and folks haven't seemed to be willing to do, probably because of the time commitment that would take.
Patty, you want to come in on that? Or?
I just agree. We don't have the manpower really to go through all those cases and try to see if we can figure out which ones are meritorious or not. But I agree it would be a really good thing to know. And in addition to that, what is the cost that's being passed on through to the premium for that? So we don't know. I mentioned that each of those intents to file litigation is work for an insurance company because they have to generate a response. So if it turns into actually being served a lawsuit, even if it later gets dismissed, it's administrative costs for insurance companies. But I can't find a good estimate of what that is. I can look at defense expenditures on the insurance income statement to see, you know, are insurance companies spending more, but you can't really tie it specifically to the activity. And it's too bad because I think it'd be really good for us to know what, you know, how much that is relative to say premiums. So we could tell people, you know, what the size of that effect is. What is the magnitude of what's going on?
I will say there are some suggestions though. So you see, at least from what I can tell, the insurance companies of all sorts, like some attract more litigation than others, but litigation across the board has seemed to go up, even if you control for the number of policies that are written. So unless you think that there's something in Florida that makes insurance companies act badly across the board, the fact that just filings go up for all insurance companies would seem to suggest that we have more of a problem than just all insurance companies at the same time deciding to behave more questionably when it comes to claims.
So Peter, let me push back on you just a little bit, my friend. First time meeting you, don't want to appear to be argumentative. Just want to kind of level set for you. In a non-catastrophe year, on average, there's about 300,000 claims, just 250,000 something. And you know, that's just for me knowing the marketplace. I've been doing this a long time. 97% of those are settled without a problem. 3%, there's a dispute. Often, like in Hurricane Ian, customers were upset they didn't have flood insurance. They didn't understand that their property insurance didn't include flood insurance. They were mad because they couldn't get contractors to show up. They blamed that on the insurance company. I listen to phone lines. I go into insurance companies and listen to phone calls. I'm one of those ones where I say this call is being recorded and I listen to those calls. So I just want you to know from experience, from hands-on, week by week experience, a vast majority of claims are settled. Check is written. Customer walks away. They got a new kitchen. They're happy with it. It's a few that make it. And I tell insurance companies all the time, you're only as good as your worst claim. Doesn't matter if you do 99% of them perfectly. So, I think the magnet of reason insurance companies are sued, I just put in the chat, just drive up and down Interstate 75. Every other billboard says sue an insurance company. I heard a commercial the other day that said, I didn't have to go in the law firm. They're going to direct deposit into my bank account what I get when I sue an insurance company. I mean, that's just the kind of wiring that we get. You see a bus driving down the road. It's wrapped with a law firm stuff. So look forward to having another cup of coffee with you, Peter, and talking about it further.
Great, thanks. Can I just follow up on that a little bit? So if what's happening is that incentives were sort of misaligned, and you had people finding that it was profitable to bring these kind of suits, whether they had merit or not. And maybe you change the assignment of benefits rules, or you do other things and tinker with the incentives in such a way that you push back on that. But what you guys were just saying, I think I heard both of you to be suggesting that maybe there's some underlying shift in the culture that doesn't reverse so easily, because now this is a thing that people know. They've become more suspicious of insurance companies in general, that litigation will not fall off because it's kind of become a habit, and there's kind of a story out there that insurance companies are screwing you, so you might as well try to screw them or something. In economics, we sometimes call that like hysteresis, where the equilibrium changes and then it just stays there because it's now there. It's like it just self-maintains. Does that, I don't know, Patty or Peter or Lisa for that matter, does that sound like a story that makes sense in Florida?
Patty? Patty, are you there?
I'd like to be more optimistic and think that it could come back down. But I do think also that the culture is there now to leaning in that direction of more litigation. I don't know what changes it.
Yeah, I mean, I think that's the concern I would have, is how long lasting is this going to be. On the plus side, it's only been 3-ish years, which I would hope is short enough that if it's a cultural shift, it could be shifted back out before it gets stuck in place. But sure, that would be the worry, is that this is hard to shift. You can change incentives in the way that laws try to do, but you'll guys need to do some more structural type stuff if you want to have some meaningful impact on this. So that could be, I mean, we can see what happens with the law has little effect on the suits that are being filed, which the suggestion is that so far there has been little effect. This could be one of the explanations for why.
All right, anybody else? Bob, Jerry, you had a comment that sounded interesting in the chat. If you do want to ask that generally, or you don't have to, I'm not calling on anybody, but.
Well, thanks. This has been a very interesting discussion. No, my point was that the fee shifting statutes that Florida repealed are similar to the statutes in many other states. And we don't see big problems happening in those states, which for me tends to make me want to focus on the AOB problem. But I don't understand why that hasn't been as big a problem in some other states as well. And I think maybe part of the answer, as I have noodled about this, is that you remember in 2004 and 2005 when 8 hurricanes touched the state. Andrew was one big event, but those 8 hurricanes caused almost twice as much damage cumulatively as Andrew did. And I saw one statistic that 1 in every 5 properties in Florida suffered damage in one of those 8 hurricanes. So I could picture the industry having trouble dealing with that amount of claim activity, and that may have caused some culture shift that has persisted in the last few years. I don't know. Those are just a few thoughts I've had as thinking about this very difficult problem.
All right, well, I have 4:59.5, so maybe it's time for us to thank the panel for their expertise and their insights. And please join me in doing that. And thank you all for coming.